Oscar Health crushed the quarter and raised guidance, but the release itself names three 2027 regulatory risks that hit every dollar of its individual market book. In this video, I'll grade the report, then walk you through how I'd trade it. Nothing here is financial advice. Oscar Health gets graded and traded. So on the top line, revenue came in about 2.5% ahead of estimates at $4.88 billion, and year over year, that's up 70%. Membership grew to nearly 3 million, up 46%. This is a real growth story. And on EPS, the headline came in 243% ahead of estimates at $1.10 per share, versus an 89-cent loss a year ago. But here's the catch. $164 million of that came from a reserve release, meaning claim estimates from earlier quarters proved conservative and flowed through this quarter. Strip that out, and the clean earnings from operations was closer to $225 million. Still a big improvement, just nowhere near what the headline suggests. So on the beat itself, and remember, we're grading against the clean numbers, not the reserve release inflated headline. This earns a B. A solid revenue beat combined with a clean operating income beat is genuinely strong, just not the plus 200% monster the reported EPS number suggested. And on consistency, this earns a D. The track record on beats coming into this print was choppy, so even a strong quarter here doesn't fix the longer pattern. Let's talk about the positives from the report. Revenue nearly doubled to $4.88 billion, up 70% year over year. Membership grew to almost 3 million, up 46%. This is real top-line momentum, not financial engineering. The medical loss ratio, which is the share of premium dollars paid out as medical claims, improved by 1,190 basis points to 79.2%. Now, part of that came from the reserve release we talked about, but even stripping that out, the clean number is in the low 80s, which is still a huge improvement from 91% a year ago. Management raised full-year operating earnings guidance by $250 million at both ends. The new range is $500 to $700 million, up from $250 to $450. They also tightened the MLR guide and improved the selling, general, and administrative expenses guide. This is the single most important signal in the print. The selling, general, and administrative expenses expense ratio compressed 450 basis points year over year to 14.2%. That's fixed cost leverage kicking in on the doubled revenue base. It's exactly what you want to see from a company scaling. And the balance sheet is a fortress now. $8.56 billion in cash and short-term investments against just $432 million of long-term debt. Stockholders' equity more than doubled since the end of last year. This company has zero solvency concerns going into the regulatory calendar. So on profitability, this earns an A. The MLR turn, the selling, general, and administrative expenses leverage, and the swing from a $228 million loss to a $362 million profit is one of the cleanest operating turnarounds you'll see in this space. Now let's talk about the negatives from the report. That $164 million reserve release aided the 79.2% medical loss ratio headline. First half medical loss ratio ran at 75%. But the full year guide is 81.5 to 82.5. That means second half medical loss ratio is expected to run meaningfully higher. So Q3 and Q4 will look worse on a headline basis. The release itself names three big regulatory risks for 2027. The expiration of enhanced advance premium tax credits, which subsidize ACA marketplace premiums, the 2027 Notice of Benefit and Payment Parameters Program Integrity Rules, and potential cost-sharing reduction funding changes. all three hit the individual market directly. And that ties into concentration risk. OSCR exited small group at the end of 2024. So now nearly 3 million members are all sitting in the individual and ICRA book, which is the individual coverage health reimbursement arrangement market. One market, one regulatory calendar, no diversification cushion. Revenue guidance was held flat at $18.7 to $19 billion, even after a strong first half print. That implies second half revenue is roughly flat to down sequentially. Some of that is the normal ACA enrollment pattern, but it leaves no cushion if open enrollment comes in soft. And the credit loss provisioning jumped to $55.3 million from just $7.2 million at the end of last year. First half provision was $48 million versus a $24 million release a year ago. It's not a crisis, but it's a signal about receivable quality that's worth watching. On guidance, this earns an A-. Management doubled the midpoint of operating earnings guidance while holding revenue flat, which means the entire raise is a margin story. They also tightened the medical loss ratio guide and improved the selling, general, and administrative expenses guide. That's a clean conviction signal on the profitability turn. And on red flags, I'm at a C. The reserve release inflated the headline, "The 2027 regulatory calendar is a real overhang, and the credit provisions are creeping up." Nothing here is a deal breaker, but there are enough real concerns to keep me disciplined on position sizing. Putting it all together, this was a genuinely strong quarter with real operating leverage and a durable guidance raise, but the headline overstates it because of the reserve release. The clean underlying business is still improving materially, just not to the 1190 basis point degree the surface numbers suggest. And the 2027 regulatory calendar, named directly in the release, is the dominant multi-quarter risk. Taking all of that together, I'm giving this print a B-. So that's my grade on the report. Now let's talk about what you actually do with it. I've broken this into 6 scenarios depending on where you stand. Whether you're looking to get in, selling cash-secured puts, holding shares, sitting on covered calls, holding leaps or underwater, or thinking about adding, find the one that best fits your situation. Okay, let's get into it. The company just lifted its full-year operating earnings outlook from a range around $250 to $450 million up to $500 to $700 million. So the profit story is real to me. But the medical loss ratio ran near 75% in the first half, and the full-year outlook implies it climbs back toward 81.5% to 82.5%. So the third quarter print will look uglier on the surface. I'd rather let the earnings pop cool off and pick up shares when implied volatility compresses and price consolidates into the fall. So for me, I'm waiting for a pullback before I start a position here. Post-earnings implied volatility is still elevated. So if I'm selling cash-secured puts here, I'm getting paid up for the risk I'm taking. The raised operating income floor of $500 million gives me a fundamental backstop when I'm picking my strike, so I anchor to that instead of just chart levels. I'd only sell strikes at prices where I'd genuinely be happy owning shares, because the 2027 regulatory calendar with the enhanced subsidy expiration and program integrity rules is a real overhang. That's why I'm selling puts at comfortable strikes and nothing more aggressive. The guidance raise looks durable enough to me that I don't need to touch my share count on this print. The balance sheet has over $8.5 billion in cash and short-term investments against just $432 million in long-term debt, so near-term solvency isn't a worry for me. The only reason I'd trim is if the position has grown too large relative to my portfolio, because the 2027 regulatory risks, named right in the release, deserve some position size discipline. For me, that means I'm holding my shares here. With the operating earnings midpoint lifted by $250 million, I don't want to cap my upside too tightly on covered calls right now. That kind of profit lift is a real catalyst for the market to reprice the stock higher. So calls sold at or below the post-print pop feel like I'm giving away the move. I'd sell calls above the post-earnings pop and use the second half medical cost normalization back toward the low 80s as my reason to pick strikes that account for a soft-looking third quarter headline. That's why I'm selling calls well above spot on my covered calls. The profitability turn here really validates my long-dated bull thesis, since operating income guidance basically doubled at the midpoint. Stockholders' equity has also more than doubled since year-end, so the financial position underneath my long calls has genuinely improved. But the enhanced subsidy expiration and the 2027 program integrity rules both hit before a typical long-dated option expiration, and those are the biggest multi-quarter risks called out in the release, so I don't want to size up aggressively into strength. That's why I'm holding but not adding hard on my long-dated calls. This release really validates the original thesis around disciplined pricing and operating leverage improving. The medical loss ratio improved 11.9 percentage points year over year. The selling, general, and administrative expenses ratio dropped 4.5 percentage points, and full-year operating earnings guidance was raised by $250 million. Averaging down is defensible for me on a print like this, but I'd scale in over a few pieces rather than all at once, because the second half cost normalization will probably hand me better entry prices in the coming weeks. So for me, that means I'm averaging down in pieces. Bottom line, this print earns a B- from me. The profitability turn is real and the raised guidance validates the disciplined pricing thesis, but I'd wait for the seasonal second half medical loss ratio normalization to create a better entry rather than chasing the pop. Thanks for watching, and I'll see you on the next one.